Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. Exciting times indeed with the US CPI, as I'm sure you're all fully aware, coming in at a very robust 3.7%. Got to remember that's twice now at 3.7% for the US CPI, and that's a re-acceleration from the previous 3.0% low. So this is deeply concerning because it means the re-acceleration of inflation in the United States is robust. We also saw the core fall a little to 4.1%, but by historic standards, that is an extreme number.
Hi traders, and thanks for watching. We'd like to take this opportunity to thank our incredible viewers for tuning into our channel. We would greatly appreciate it if you could hit that subscribe button, as we're pushing for the 10,000 subscriber mark by the end of the year. Now back to the video.
So there's not a lot here at all to give the Federal Reserve any degree of comfort. In fact, they will, if anything, lean a little bit more into the idea of another rate hike. I actually think the market is still underestimating the long-term nature of the higher for longer catchphrase. So I've said all along that US rates would go to these levels when everyone thought that was an absurd forecast, and I'm on the record on television and radio and in our reports here for saying so very early on. And at the time, everyone thought these were outlandish forecasts. And still the market does, because we have to realize the market's view on interest rates has been wrong for 2 years now. And I think they're still wrong in not fully appreciating, fully pricing, either in the bond market or in equities, in the futures market regarding short-term rates. They're not fully appreciating how long longer is. So, you know, the aberration was that we had low rates. This is normal. It's just that a lot of people haven't been around long enough to know that this is normal, but it most certainly is. And this is why the Federal Reserve has said it will keep rates up here until inflation is back to its target, because up here is actually, by historic standards, pretty neutral. So it's only people who've been in the market for a short while that think rates are high now. They're not. They're not. So equities have not priced in that interest rates in the US can stay at current levels or higher for the next 12 to 18 months. And then from there, if there's inflation spurt yet again, they'll go higher. So that is something the market does not have its head around. And that, I believe, is a market opportunity, because the biggest moves happen when markets are wrong. Market sentiment is wrong. If market sentiment was correct all the time, the market would barely move. The market is always wrong. It's always seeking a correct price. That's what gives markets their volatility. So never ever put too much emphasis on what futures pricing is, or even on what Federal Reserve members are themselves saying, because sometimes they haven't figured it out and they will change their minds. As in, they thought inflation would be transitory. I said it wouldn't be. They thought they could leave rates near zero forever, but they couldn't. So central banks and their presidents and their chairmen and their governors make mistakes all the time. So we have to think for ourselves. We have to look out the window. I call it look out the window economics. It's my mantra. Look out the window, can apply logic to what's going on in the world. And what is going on in the world is ever higher geopolitical risks, sanctions against oil exports and energy exports, disruption to energy supplies. So energy prices are going to go up from where they are now. So oil's had a good dip. I was a buyer of the dip in oil yesterday, and I remain a buyer today. Energy prices are going higher. But there is no elasticity left in the US or other economies for yet again an energy crisis, but maybe not a crisis, but just firm energy prices, because everything's so tight already and there's already so much uncertainty in the economy that businesses aren't prepared to reduce prices. If forced to, they will, but they're not going to reduce prices too much because they're worried about the future, and they may need any revenue they can get now to get through yet another economic downturn that most people can pretty clearly see now is on the horizon. So pricing pressures will remain tight, and any increase in energy costs, transportation costs, will immediately be passed on to the consumer. There's not going to be any absorption by businesses of higher energy and transportation prices. So that means the US CPI data is highly responsive to the price of oil globally. That price of oil is going to go back above $90, retreated from 96. If you remember, I thought around 97 could be resistance for oil for the time being. We moved to the bottom of what I think is a comfortable range for OPEC. Now we're moving back towards mid-range. Oil prices will stay elevated. They may well go to 104, 110 next year, and that easily puts US CPI back, the headline CPI back above 4%, and the core possibly above 4.5. So this whole inflation war, if you like, is not yet over by a very long shot. Long. Rates are going to be so much longer, higher for so much longer than the equity or bond markets are currently pricing. Something to keep in mind and be aware of as a positive market opportunity. Thanks very much, Clifford Bennett.